Hi everyone, Chris and Lesa here with Rain City Capital.
We hope you're having a wonderful December and enjoying family and friends as we enter in the last 20 days of the year.
This month, instead of hosting a live class, hard money class, we're bringing you Hard Money on Demand. It's a pre-recorded class that you can watch anytime online.
We will totally miss your smiling faces and answering all your questions live. But we figured since this month is so busy that we will make sure that you guys have access to all this information no matter what your schedule is.
So even though the class isn't live, you can still reach us anytime with questions or ideas. Call, text, email, whatever. We're here to help you be successful.
Yes, your success is what it's all about. So with that being said, here's Hard Money on Demand. See you in January.
Hi, everyone. This is Hard Money on Demand. This is kind of a primer course talking about what hard money is, what types of hard money loans are available, and also how to get a hard money loan.
Yes, we'll be showing real life deals and case studies towards the end of the class. So you'll see how our borrowers have been successful and has done their deals that works best for them and hopefully inspire you. So let's get going. My name is Lesa Say. I'm Rain City Capital of Washington.
And I'm Chris Burdick, Rain City Capital of Oregon.
Awesome. Right now, we lend in Washington, Oregon, Texas, and Tennessee. We will be giving you a brief overview of all the things hard money has to offer and how we can help you be successful in your projects. Let's do this. All right, let's go to the next one. So what is hard money? That's a great question. And this slide is about the overview and the basic, just 101, what is hard money? It is an asset-based lending. We look at the asset first, then the individual versus conventional financing. They'll look at you, they'll get you approved, get your credit score, and then you go out shopping. Similar, but we want to make sure that that asset makes sense and that the deal makes sense. We're not a traditional lender, meaning we understand that your roof might be falling apart, siding, or need a new window or something that needs to be fixed because you're buying it at below market value with repairs needing to gain that equity. So we understand that. So we understand that there will be fixes and repairs needed. We also are not credit based. We look at that asset first. So we understand if your credit was a little bit before, as long as you're currently current. The biggest thing and the hard stop is we are for investment only. You cannot live in this property. It cannot be a second home. This is for a business purpose only. So a brief overview of what hard money is it's asset-based lending. It's not a traditional finance institute. We do run your credit. We do, need a bank statement, but we don't need W-2s or tax returns or anything like that. And it's for an investment purpose only. So the next couple slides, we'll dive in on how that looks and how it can benefit you using hard money to purchase your next project. So let's go to the next one.
Awesome, guys. Lesa, thanks so much. So guys, benefits of hard money. So you're seeing that hard money is a little different than conventional lending. The big benefits of hard money, the first being speed. So we can do transactions a lot faster than a traditional lender. We've closed things in as little as a couple of days. A lot less documentation, a lot more less stuff needed. And so, speed is definitely a factor. You got to close that thing in 7 days, 10 days to get that deal. That's something we absolutely can do. Freeing up your cash. So a lot of guys and gals try and do deals, funding their own stuff and buy the property, do the renovation. What hard money allows you to do is keep your capital back and to do more deals or have more flexibility. Let us finance it for you so that you have more capital to maintain your flexibility. And the last thing is the biggest thing, like kind of Lisa touched on it before, we're not a bank. And so we don't have a lot of the red tape that banks have. We don't have those guidelines they have. We kind of live in the gray area of lending of let's try and do something that's going to be creative, something that's going to make it work. If we run into a roadblock, oftentimes we can just figure out a way around that and still close that deal. It kind of makes this business a lot of fun for us and for you.
Awesome. Love it. So how would someone get started using hard money? First, you have to apply. Super easy. We do an application online. We get your bank statement. If you're investing in an entity, we'll ask for your operating agreement. That's pretty much it. We email you that information, you get back to us. We get you pre-approved. What's amazing is we have an amazing program that once we get you pre-approved, we'll get you approved for X amount, and then you have accessibility to proof of funds 24/7. You go online, you say, I want this address at this price vesting in here, and boom, you have a proof of funds letter. Of course, we will get a copy of that and we'll follow up with you, keeping that line of communication going, but you have access to proof of funds once you get pre-approved. Once you get that deal, you'll give Chris and I a call and you will say, hey, I got this deal, or you can call us before, which we like, but you give us a call when you got that deal. You tell us your purchase price, renovation, ARV, and we get you going. It goes into escrow, just like a traditional financing company would use, because they're a third party and they're the ones that close it. We fund and record just like traditional financing. Chris, what any ideas or anything you would like to add to that?
No, I think you kind of nailed it. I mean, obviously along the way, the reviewing of the deal, sometimes things change while you're in the due diligence period. And so we can adjust on the fly if we need to change the loan a little bit to make it fit and go back into underwriting review. If you're bringing money in from other sources, we can work with that as well. It's just, I would just say consider Lesa and I your advocates in these transactions. We're all trying to make it work together so that you can close the deal and you win.
Absolutely. Love it.
Okay. I'll take this one. This is a kind of a standard fix and flip, also known as bridge with RENO. When we say RENO, that's not the RENO, that's renovation. And so bridge with RENO, the rates on this stuff, typically with hard money lenders, they're going to see things between, 10-12%. For us, we're more 8-12%. Depends on the market and the location and also the experience level. So the more experience you have as an investor, the lower and lower and lower the rate goes, because you built that experience up, and it's less and less risk for us because you got that experience to be successful in those deals. Our standard fix and flip loans are up to 18 months. Typically we do 12 months, but on occasion we can go with the extended and go to 18 months. Origination fee starts at 2% of the loan balance, so they call it 2 points, but can go as high as 3 or 4 points depending on the deal. But most often you're looking at a 2-point origination fee, 2% of the loan amount. Up to 90% LTC on these loans. What that means, guys, is loan to cost. So when we say loan to cost, that means you can consider that just on the purchase price or the purchase price plus the renovation. We can go up to 90% of that, depending on experience. Typically, most borrowers are going to see things between the 15 to 20%. We can go as high as 10, meaning we'll cover the first 90%. You can cover the last 10%. Closing date we talked about. We can close in as little as 48 hours. I would say for Lesa and I, probably most of our borrowers are closing with 7 to 10 to 14 days. Is probably more typical. Doing those 48 hours can be done, but it's also very stressful for everybody involved. You're jamming through a lot of paperwork all at once. Usually in situations we're rescuing somebody else's deal and they already have the title report and all the pieces in there to close in that 2-day period. But totally possible with us. We've got a great team that backs us, processing team and underwriting and the whole thing. So that can be done very quickly, the fix and flip bridge loan.
Absolutely.
Okay. Let's see.
Perfect. I think what will happen next is Chris and I are going to go over a couple illustrations and examples of how to use hard money. There's about 3 or 4 slides that I'll talk about, and then Chris will jump in and talk about the other programs that we have. So Chris talked about using a bridge loan. Bridge with renovation or without renovation. And here's an example. And why we like to walk through these numbers. Now, granted, I know we're not live and I know we're not in person. So a lot of times this is where we get the gist of the questions that we have. So of course, reach out to Chris and I about this, but this is the nitty gritty of hard money. And what kind of questions we're going to ask you? We're always going to ask you, what's the purchase price? What's the renovation? What's the ARV? So in this example that we're using, you're going to see two boxes. You see Rain City Capital and you see Magnolia. You're probably like, what is that? Well, the beauty of us is we have the capability of diving into two different, if you want to call it, funds. We have Rain City. Think of it as very gray, think outside the box, cash collateral, all those things that are creative, which we will discuss. It comes with a little bit higher rate. Or we have, for the experienced borrower, the more you do, the better rate, Magnolia. So we just like to divide those out so you kind of would know the difference. So in that example, the first one, let's say you were required 15% down. One of the main questions people ask, is it 15% on just the purchase or is it 15% on the renovation? It would be 15% on the 350. So the renovation plus the purchase price, okay? With that being said, you will have a rate of 12%. 12% is, creative financing, maybe your first time. That would be your rate at 12% interest only annually. I'm going to stress that again. It's interest only annually, meaning if you had a 12% interest rate loan, it would be 1% a month, 1% for the 12 months. There's no prepayment penalty. That's the beauty of Rain City is we don't do 6 months. And, if you're going to hold it by the time you get done with the renovation and you got it rented, now you're like creeping maybe on that 6 months. So you have 12 months to figure out what you're going to do, plan A or plan B. So with Rain City Capital, with the 15% down, it'd be $52,500. Origination is typically about 3 points. That's why you see the higher amount of the origination. It's 3 points versus Magnolia is 2 points. And the rate is different. So that's the huge distinguishing factor between the two. Rain City, outside the box, let's say it was a rural zoning or you're brand new, your expectation would be 15% down, 3 points, the rate would be at 12% interest only. Magnolia, let's say you have one underneath your belt, so you can start capitalizing on that 10%. See the difference? It jumps from 12 to 10%. The next deal, if you have 3, you go to 9, if that makes sense. The origination is only 2 points, so you save on the points. And this is still with the down payment at 15. But just know that with the renovation and bridge loan, you can get 10% down if you've had 2 deals and your credit score is above 700. So a little caveat. So the more you do, the better rate you get. So if you look at the very bottom, it pencils it out. And so I want to talk to you about LTV. So that is loan to value. Every hard money lender is going to loan to value and loan to cost. So that loan to value means you take your purchase price plus your renovation minus your down payment. So that's 15%. So follow with me. It's $297,500. You take that $297,500 and divide it by your ARV, after reno value, what you think it's going to be worth at the end. With that, you get a number. That's your loan to value, 59% LTV. Our max loan to value is 70%. So if you brought this deal to me, I'd be like, yes, perfect. Cooking with butter. Let's get this deal done. This is a great deal. You're 59% LTV. We would say in the asset-based lending world, this is perfect. This is a good deal for you. So just kind of like reiterate, because I know this is a lot, and always reach out and ask questions with hard money when you're doing a deal. Chris and I are always going to ask you purchase price, renovation, ARV, after reno value. We will then determine what your LTV is. And this is something you want to get expert, like you want to be able to run these numbers pretty quickly because we're going to need to know what your LTV is. So you take that minus your down payment and divide it by your ARV, and that's your LTV. That is how you formulate, in a nutshell, a hard money loan, okay, with renovation. Okay, so we get a lot of questions about draws and interest. So what this means, what's a draw? Remember how you put in the renovation budget in your loan. We are going to help fund the loan, the renovation piece of it. What that means is you do the work, we reimburse you. So let's say I'm going to give you an example. Let's say there's roofing. You finish the roof, you call for a draw, we reimburse you. So that's how that works. Okay. Then your interest, you're only paying on what you have out. So let's say you have that $50,000 renovation budget. You're not paying monthly on your renovation budget if you haven't drawn from it and it's not in your pocket. So just to recap, your draws and how you get funded is based on completed work. You only pay for what you have used. At the end of the loan, if you haven't used any of it, your payoff is going to be lower. If you have, then it will go up to that said allotted amount of $50,000. Chris, do you have anything you want to add on that?
Well, I was going to say, and I always say to my borrowers is when we calculate that interest payment, that loan balance, we calculate that daily. So if you drew out, say, $10,000 on the 25th of the month, you would only be charged on that higher loan balance for that last 6 days. There are some hard money lenders out there that'll charge for the whole month or the whole loan balance along the whole way, or the whole loan amount that you funded. But for us, that's a great money saver for you. Of you're only paying on what you borrowed, calculated out to the day. So I would add that piece in. That's it. But otherwise, you're awesome. I love watching you, Lesa. You're like the best presenter.
Oh my God, you're so sweet. I love you. That's very sweet. That's very kind. One thing I want to add to this too is some people are like, well, I have the funds to do the renovation. It doesn't matter if you have the funds or you don't have the funds. People use hard money to leverage their funds. So why it's like almost like a savings account for you if you want to use that example, because you never know what will happen with your project. Chris, I'm sure that this has happened to you, maybe one of your borrowers too, where they go into a project, they knock down a wall, and now they have mold, right? Or something,
yes,
like some example that's outside their scope. Well, let's say they only had a budget for X amount. Well, now if they would have put the renovation in it, they could have been reimbursed. So they would have less money out of it. So it's kind of like a safety net. You don't have to use it if you don't want it, but it's there if you need it. And I promise you, when you need it and you don't have it, you'll wish that you put it in. So I am sure and confident Chris will also agree, put renovation in your loan, even if you think you have it.
Yes, leverage. Yeah, exactly, guys. Money is cheap compared to having to come with all on your own. So I would say I would add to this too. You guys are probably seeing delays when you order something and it gets to you later as far as materials, or contractors are getting delayed in their projects, or surprises come up. I would definitely, if this is your first couple of deals, if you're a novice at this, definitely put in on the cost overrun or contingency line item. Make sure you're doing at least, I would say 10%. People do 5%, but I usually recommend at least 10% in your cost overrun line item for your budget. It's easy to have it in there. It's harder to get another 10,000, 20,000 later when you're stuck behind the wire. It's much easier to just do it up front, have the extra money in your renovation budget, get that approved through us. The money's there if you need it. If you don't need it, like Lesa said, you don't get charged for it.
Right. And actually just while you were talking, I had a borrower call me yesterday. He had a $60,000 renovation budget. He's like, Lesa, I haven't used it. I'm like, okay, you haven't used it. It's pending. It's going to close next week. And I'm like, guess what? You have now $60,000 as a down payment on your next deal before this one closes. So if you want to use it, you can draw it before, you close. So there's so many enriched reasons why you would put the draws in it, especially since you don't pay for it when you don't use it. So Chris and I are, I think, a little passionate and have seen some negative things when you don't. So we strongly suggest it. So anyways, okay, let's move on to the next one. Okay. So auction. Chris and I are in different states. So I'll talk about Washington real quick, and then I'll just let him touch on Oregon afterwards. I can go to Pierce, Snohomish, and King when things are up and running, because to be perfectly honest, it's kind of stale right now because of COVID. There's not a lot of good deals. It's very competitive for the one or two that are going to go. So we traditionally would have one person at each one of those auctions. We can go, there is someone actually in Texas. I know it says no Tennessee. So we have someone at Texas we can get you in touch with. But as of right now, it's really Oregon and Washington are our main auction places that we lend to. We don't charge in Washington any other fees. So some companies will charge you like a 3% or 4% to just bid. My philosophy is kind of, I'm going to get the loan, so I'll go. For you, you have to be pre-qualified first. I will not bid if you're not pre-qualified. You have to do an application, show me your liquidity. I have to see the property. We have to pull title, but they're always Rain City terms. If you remember, I said, think outside the box, Rain City. This is one of their loans, 20% down. They're right at 12. Now that's Washington. They do things a little different in Oregon because, Oregon's a different state. So Chris, you want to just talk about Oregon and how that works for us Oregon peeps?
Yeah. So you guys, for those of you that are in Oregon or you do some deals in Oregon, you guys know Oregon's a little more egregious with their laws and regulations than say Washington is. So we kind of have our differences there. But in our experience right now, Oregon, it's kind of dead right now as far as the auction go, because there's still those eviction moratoriums or foreclosure moratoriums that are still in effect for Oregon. They're projecting that you'll see auctions kind of like coming a little more alive in like January, February. So a lot of people just kind of like, stashing their cash, getting ready for the buys. But it's very similar to what Lesa said in Oregon as well. So we can go to auction for you. Definitely, Rain City terms, 12%, 20% down. Standard, 3 points as far as origination. We can go to auction steps for you and bid, and same thing, get pre-approved. And I think Texas is very similar too, although our counterparts in Texas are crushing it with auction. I mean, Texas has auction all the time. They're kind of a lot more free range out there. So if you guys are looking to do auction in Texas, there's a lot of capability there. So definitely reach out to us for Texas auction as well, because they have a different thing. They have what's called a Super Tuesday. And so it'll be like, every the first Tuesday of each month. Thank you. Each month. And it's like a madhouse in multiple counties, and there's people, it's like the stock market exchange. They're bidding their money and doing their thing, but we can go on your behalf, bring a cashier, checks, buy the property, and then we finance it for you after the fact. And so definitely something that's capable there. But yeah, Oregon currently quiet. Hopefully it's picking up here in the next month or two.
Absolutely. That's same with Washington as well. It's quiet, dead. It's the highest risk way to purchase, in my opinion. And right now it's very hard to get a property. So I always think of it as my time to chat with all the other investors when I go down there, because we're all standing around waiting for one to get called, and then it doesn't call. So it's our social hour and mingling with people, which is great when you're an investor. So that works. Perfect. Well, let's go to the next slide. I think this is my last slide, and then Chris will be up. Okay. So cash collateral. This is an amazing tool to use if you are going to hold the property. So let's just recap. The bridge with renovation or bridge without renovation, those can be for fix and flips or buy and holds. This is a Rain City type of loan. It is for if the intent is to hold. And Chris is going to go over our 30-year program. So this is beautiful matchmaking for it. But if you go somewhere else, that's good too. But it's an opportunity to keep your funds in your pocket. And this is what I mean. Let's say you have a purchase price of $300,000. Your renovation is $60,000. Total loan to cost is $360,000. Down payment is $72,000. Now, normal traditional loans, you would take that $72,000 and then you would wire it to escrow. Well, we're actually using those funds as collateral. So we're using almost like we have a collateral property loan. This is just we're using your cash as collateral. So instead of having a loan for $288,000, because when you take out, that's what your loan would be. If you wired it to escrow, your down payment, your loan would be $288,000, right? But if you're using your cash as collateral and you're wiring it to Rain City, and there's another agreement on that, and when it closes, you get it back, you actually have a loan for $360,000 because you're just using your down payment as collateral. So you're paying on $360,000 because that is your loan. But when you go to take out, you can do a rate term instead of cash out. So your rate term is going to increase. I'm sorry, what?
better rate and rate term
Oh
versus
yeah, that's where I was heading. So
Yeah.
your rate and term is 360, which is a rate and term, like Chris was just mentioning, versus a cash out rate at 288. So this benefits you tremendously on being able to get your cash back out and getting a loan at that higher value. So this is perfect if you know what your end exit strategy, which you always should know. You should know that plus an exit strategy of a plan B. But if you know, hey, this is going to be hold, what I would suggest you doing is you call Chris and I and say, hey, I want to buy this loan. What can you size the loan for a 30-year? And we'll tell you, does that rate term, here's are your rates and here are your differences. So you can make the best choice, because to be honest, at Rain City, we have everything that you need. Like, we're a one-stop shop. We have so many different programs. If you have a deal that makes sense, we will figure out what loan works best for you. And not every single deal falls in this loan, this category. It's like, okay, what's your exit strategy? What's your objective? What are you trying to obtain here? And then let's fit a loan that met that need. This need is, are you going to keep it as a rental and get that cash back? And then you can move to the next property. With this, Chris, do you want to add anything on that?
I think you nailed it. No,
Okay.
Yeah, you did great.
Okay.
Yeah,
All right.
wouldn't do the thing. You're great. Yeah.
Perfect. I always love, we're a team here, right? So it's always good to get inside and both of us opinions on it. Another thing is we're super fast. This is the loan product and can go pretty quickly. You're using it as collateral. It's a Rain City. This is perfect for Burr. So let's go to the next one.
Cool. All right, guys, I'll take this one on new construction. So I would say bread and butter for us and across the market and hard money in general is fix and flip loans. Would you agree, Lesa? I mean, it's mostly fix and flip, but the new construction is kind of the next tier in the blockchain. And then we do new construction lending as well. So if you're going ground up, whether it's you're building a house from the ground up, or a multifamily from the ground up, or you're doing an ADU or condominiumizing things, any kind of ground up, like detached from another structure building, is new construction. And people ask, what does it look like? And I say, well, it's very much like the bridge with RENO in terms of construction draws are very similar. The big difference is you're going to see, actually, let me back up. New construction on there, this is a single family, multifamily 1 to 4 units. You'll see townhomes, condos, anything in that kind of zone. So people do like multiple homes and ADUs or various things in the same complex. But so it covers a lot of ground. We don't do new construction of, like, say, commercial buildings or industrial or manufacturing or any of that stuff. It's not our jam. It's all residential, guys. Typically you're going to see loan to cost 80-85%. Meaning you as the builder borrower would be bringing in like 15 to 20% down in that scenario. Rates are 9 to 12%, depending on experience and the deal and location and money and pretty much everything. So we kind of look at everything, assess it all together, and then determine what the rate is going to be. So if you have a deal, bring it in, we'll look at it, and we'll try and assess it as best we can up front. And then as we gather more information, we'll be able to give you more hard, definitive numbers all the way to underwriting decision. Big key things in new construction, and here is we do an appraisal. So it's something that the borrower pays for, and they do an appraisal of as is value, and then the appraisal also looks at, with your plans and budget and plat map, okay, what's this property going to look like at the end, and then they take that and look at what are the sold comps in the area and what do we think the ARV is going to be at the end. So it's a double appraisal there. And then the big thing is I want to see a list of your soft costs that you spent. So I want to see what you bought the property for. I also want to see like everything you spent so far on the property, whether it's engineering, the plans, any kind of soils work or permits costs that you paid. I want to see all that stuff, because all that stuff, the price paid for the land and all those soft costs can apply towards your down payment contribution. Typically on a construction loans, where we come in is right before or right after you get building permit approval. So you bought the land, maybe you knock down a structure, your structure intact, you develop your plans, your plat map, you do all those things, you do all your work and going with the city. And once you're about I would say 9/10 of the way done to getting permit approval. That's when you would come to us and say, hey, I'm going to get permit approval in like 3 weeks or a month or 2 months or whatever. You start bringing your stuff to us. Here's the plans. Here's my plat map. Here's my budget and scope. We order the appraisal, and that's where we would come in. So you can do the land loan up front, which we'll get into here in a little bit, and then we can loan you money for the land, and then do your own spending on as far as the soft costs and the development costs and that sort of thing, and then we can reimburse for that later on if there's enough room in the deal. We can get into that on a deal by deal basis, but that's kind of new construction in a nutshell. Lisa, do you think I missed anything on there? Like, help me out.
No, you're solid. You got it, buddy. Like, okay. You're awesome.
Cool. So guys, that is new construction. 30-year rental loans. This has been a cool piece for us this last year. It's really blown up for Rain City Capital and also kind of the hard money space in general. 30-year rental loans, kind of in the non-conventional space. So these are 30-year amortized loans. It's a fixed rate. Rates start as low as 4%, which is actually competitive with conventional lending right now. It's made for investors. So what they mean by that is, we can go up to 80% LTV, 75% on a cash out. What's cool about it and different than Fannie Mae, Freddie Mac, which have a limit of 10 properties or 10 loans, and sometimes less depending on your debt to income ratios. With these loans, there's no limit. There's no cap of 10%. You can have 10 properties, 20 properties, 50 properties on these things, as long as you can show that you're cash flowing on the property, you got some capital in the bank to be able to fund 6 months of payments on that property, you can just keep going. So there's the guardrails that are on there for conventional are different than what is for these kinds of loans. No red tape. So we're not looking at DTI. We're not looking at W-2s, tax returns, financial statements. We look at, as you as a borrower, we look at kind of a couple of things. We look at the credit score. So we run a credit and background report. We want to see how much money you have in your bank account. And we want to see if there's a tenant in there. You can do loans on a purchase deal if there's no tenant, but the terms are a little more conservative. Generally, our clients already have a tenant like signed up on a lease. They've made at least a security deposit, maybe a first month's rent, or they're already in there for a while. You can show 2 months of rental payment history. But so let's see, next slide on here. Make sure I didn't miss anything. Okay. Let's see. Yes. So this is a debt service coverage base. So DSCR, fancy way of saying does it cash flow a little bit. So your expenses are this, your income is this. Make sure you're making a little bit. The ratio we look for is usually about 1.1. There's some flexibility in there, but that's typically, you want to make sure you cash flow a little bit, as most investors would when they're buying long-term rental property. Cash requirement, you want to make sure that in your bank account you can show that if there's a down payment, you can cover that. You have enough money to cover the closing costs if that's needed, and then 6 months of payments in the bank, kind of similar to Fannie Mae, Freddie Mac. They want to see that if you have a tenant move out, can you handle 6 months of vacancy on your own out of the bank account? So the 30-year loan, I would say for this kind of non-conventional loan, it's really good for borrowers that don't qualify for conventional loans. Either they're a business owner that doesn't have W-2 income and it's not, kind of fit that mold. Maybe they got some tax return issues that, maybe they haven't filed a couple of years, or things are up in the air, or they're redoing some taxes and they can't show that. Or, there's a lot of unverifiable income. Let's say you're really good at you're a great CPA and they show you made like $30,000 that year. You may not qualify for that $700,000 house, or that, or that duplex, triplex that you're trying to do, or that house in general. We don't look at that stuff. And so ours is much more about basic stuff like good credit. Are you a person that pays their debts? Does the property cash flow? And do you have money that you have cash in the bank to cover the payments? So, business owners that have multiple businesses, a lot of times you guys, that are business owners, they have multiple things going on. They ask for this, they ask for that. They want more overlay and overlay and overlay. I have friends that are in this boat right now that are like so frustrated. They go 6 months trying to get a conventional loan, but being asked for this and that. It's one more thing and one more thing and one more thing. I have some clients right now, Lisa, that came to me, my friend Kayla, she's like, forget it. I've been trying to get this loan with conventionally for like 6 months. I am done with these guys. And so she's doing all our loans with us, and we're already moving forward to the next step on 3 of our properties right now. I told her we'll have it done in like 45 days.
Nice.
So
Love it.
it can be way faster for the 30-year. Let's see, let's go to the next slide here. Oh, I should say, but back on 30-year, one more thing. Minimum credit score, I think it's 630. Is that right, Lisa?
680.
Oh, I thought it was 630. Okay.
The rates don't seem to be very, I tend to
They're
like
really unfavorable. Yeah.
Yeah. You might as well just do 680.
Yeah, but it's going to be pretty bad. Like you're going to have pretty low loan to value, and you may pay a higher rate if you're a low credit score. So yeah, generally
we can do it.
We can do it. But generally, we want, you're going to get better and better rates the better credit score you have. So if you have low credit and you want to get a better rate, pay down some of those credit cards, get your rate up, and then we'll run your credit and background. You'll get a much better rate and much better loan to value. And so all those things play a factor in there. Let's see. I think that was it on that. And then loans on land. Guys, this is basically a different kind of bridge product. So we talked about, bridge with RENO and regular bridge. Loans on land is very similar. It's a 12-month term, just like the other bridge loans we have. This is a portfolio loan because this is a handle in that creative space Lisa was talking about before. So 12% interest only, 3 points. Origination, very quick close because you're not having to evaluate a lot. No tax return income verification. Typically, the max we can do on loans on land is 50%. So if you're buying a property for $100,000, it's just the lot, we would fund up to $50,000 on that land. Now, we have a bias towards urban and suburban land. If it's out in the country, we may not even do it, or if we did do it, it would be like a lot lower loan to value, just because rural land is very volatile. And so to hedge that risk for us as the note holders, we'll dial down that leverage point to kind of be a little more conservative in that. So loans on land, generally urban and suburban. I don't think I've ever actually done one in rural. Have you done any rural land at all, Lisa?
I have, but it's odd. We're all relationship based here. Like that's what Rain City is about. And so if you have a client that is done,
right borrower.
But that's not something we would do. Like if you're just starting out and you haven't done any loans with us, that would be a negative ghostwriter. We would not do it.
Yeah. So the scenario for why you would buy land is pre-construction phase. So let's say you're going to buy this land and you want to build on it, and you need to carry that land. You buy that land before you do all the permits, and you go through the city of Portland. My gosh, it's going to be almost a year in itself just to get permits approval. But in some of these like mid to smaller towns, you can get it done in like a month or 3 months or 6 months. It's a lot quicker. So pre-construction phase, and you get a loan on it, so you can free up funds to do your soft costs and pay you for your permits and pay for your architectural plans, and also to be able to make your payments on various other things. So that'd be a situation like that. Maybe it's just a regular bridge loan, like you got this land and you own it free and clear, and you want to harvest some of the equity from that to go do something else. Maybe you want to go buy another property. So you would do a loan on land to harvest some of that money in a loan, and then go to that property, and maybe you do a fix and flip or something out there, and then you pay this money back within the 12 months. You can also buy the land to develop and sell lots. So say you buy a piece of land, you're going to carve it up into a different plat and it's a big piece. Maybe you're going to carve off like 10 lots and then sell those lots off. So that's another option to do as far as land investing. So lots of options for loans on land. So you kind of know what that looks like. Let's see. I think that's it for my slides. And I think Lisa's going to bring it home with manufactured homes and on from here.
Yes, absolutely. So as you can kind of tell, we have lots of options, like I mentioned before: cash collateral, land collateral, 30-year, buy a bridge, renovation, bridge without renovation. And this, before the fires, I know a lot of us here in Washington and Oregon, about the fires in the summer. This was on fire. People did manufactured home swaps or manufactured fix and flips. Right now, unfortunately, we see a lot more manufactured fix and flips because the hold on purchasing a brand new manufactured home is probably about 9 months to a year delay. So we haven't seen a lot of that, unfortunately, in the last, I'd say like 6-7 months, but hopefully they will get going and people can have the opportunity to do a manufactured swap. So right now, what I'm seeing is people are buying a manufactured home that maybe just needs to be fixed up, needs to be a little bit, put some lipstick on there, or something needs to be fixed, or they buy it because the title's not eliminated. Of course, that would be a land deal because you have to have the title eliminated. Big flashy words there. It's not a home if it's not attached to the ground. It has to be title eliminated. If it's not title eliminated, you got to do a land loan. So sometimes people will buy on the land because they're going to get a title eliminated and they can do a really good deal and then they can fix it up and sell it. Or they just find one that's attached to the lot. It cannot be in a park because that's a whole different thing. It can't be in a park like that you are leased land. It has to be able to own the property that it is attached to. They fix it up and they flip it. This is the Rain City thinking outside the box kind of loan. A big thing here is just title eliminated. It's just like a bridge loan. It's the exact same thing that we would use. You just can't use Magnolia money for this. Sometimes people are buying these, fixing up, and then dividing the lot and then doing new construction on the other side. So there's lots of creative ways to make this happen and affordable fix and flip, or if you're starting out, or people are buying these kind of at a hot price. I actually have one really amazing, awesome borrower that this is like her bread and butter, and all she does pretty much is fix and flip manufactured homes, and she's making a killing off of it. So this is definitely something, if you haven't thought about it, look into it, see what it means, but just know that if you're going to explore the purchase, you need to talk with the dealer. I can get you connected with the dealer, but your hold time and your hold cost is going to be pretty costly because it's taken a while to get those homes. So another option, another way to invest, another way to be successful if that's in your wheelhouse. So on to the next slide.
Love it.
Yes, now we're going to talk about our borrowers. Go for it, Chris. Some deals.
Yeah. So guys, this is a case study. This is a borrower of mine. This was a home in Oregon, and she bought this thing for $197. As you can see from the pictures here, it was just like a dated place, older, kind of unkempt, and she put $60,000 into it. So she got, a new roof on there, did painting on the interior, exterior. We did a new kitchen, new bathroom. You can see on here that, she's got, new cabinets, new countertops, new appliances. It's kind of the standard fare when you guys are looking at, what we call a cosmetic redo. Typically, the cost is going to be somewhere between 30 and 70, depending on how deep you're going with that cosmetic redo, where you're not adding another room or a square footage or bedroom or bathroom, just a straight up cosmetic one. But look at the deal. I mean, she put basically 200 into it, 60 into the renovation, and then turned on ARV'd it and sold it for $329. So in that deal, after fees, she made a good, healthy $50,000 in that deal for 4 months of work. So, and this is an experienced borrower we have. I think she's done probably 6 deals with us. I think this was her third or fourth deal. So, just an example. But I mean, all this stuff, guys, can be sourced through the Home Depots and Lowe's and those kind of companies. You can also go through private vendors that have materials, and make sure you have contractors lined up. But this is case study number 1. Lesa, take the next ones.
Awesome. So this is a borrower that I have in Texas. He is all about end game hold. He wants to hold the property. He used to buy with cash and then do takeout on a 30-year, but now he actually uses us for hard money as well. And there's another slide for it. And then he goes in and goes into our 30-year because he's like, why would I pay $155,000 of my own money right off the bat instead of just putting 15, 20% or sometimes 10% down? So it's all about leveraging, right? But this is an example of he bought it in cash. He purchased it for $155,000. He only put $5,000 into it. It just needed a nice little touch up. I think a little bit of siding. There was something about a roof that needed to be just patched up. He got it from a wholesaler. He's been doing this long enough that wholesalers just start feeding and stuff. So people always ask, where do I find the deal? It's almost like just a wheel. Like you got to just get going, and then the word gets out, and then you start meeting new people and meeting wholesalers. And Chris and I can connect you with wholesalers, but this one just kind of dropped into his lap because he has a great wholesaler that feeds him stuff. But it's the loan, the value was 247. So he all in was 160, and it's worth 247. I mean, that's a screaming equity play there. And it rents out for 1,600. So, I mean, this is a killer. He was very happy skipping all the way to signing. He was very happy on that one. So then awesome. The next slide, when I met him, that property, he was, like I mentioned, just needing us for a 30-year because he was buying cash. And then he's like, wait, let's talk about hard money. How does this work? So he got another one for 248, put 25 into it. This one needs just a little bit more updating and some repair. And it's still like about $100,000 worth of equity. It was valued at 350, and I did the takeout and appraised at that. And he's getting rent for 2,600. So these were those two actually were kind of recent. So there's our deals out there. Just you can find them, get out there, talk with people. But this was another screaming deal that he did. So I think the next one is you, Chris.
Yeah. Guys, so we, Lesa and I kind of laid out a lot of the different loan programs, how to get a loan, what is the process, and so on and so on. I guess at this time, I just want to show you guys, I mean, we're not the only hard money lender out there. I mean, I think for us, we're the only one out there, but there are other options out there. And so why choose Rain City over the other lenders? And I would say, hard money lenders can be a pretty sharky business. In all seriousness, there are lenders out there. They're just out there to, their model is to do kind of a high interest hard loan that there's a very likely possibility they'll take your property back because they'll make more money taking property back than they will off of the loan itself. And so you got to be really careful out there about who you line up with, what hard money lenders you're working with, what happens when things go south in a deal. Are they going to take care of you? Or are they going to leave you out in the cold and just let you flounder and then and lose? One of the reasons that Lesa and I are both here at Rain City Capital is there's an emphasis on the human element and the partnership between the borrower and us as a lender. Like our mission is to make sure that you guys are successful. We have this long-lasting relationship. Mutual lasting success is not only on the mission statement board, but it's something we live every day of when things are happening in your deal that are out of your control, or if problems are coming up, as long as you're being transparent with us and you're working with us, we'll take care of you. We'll figure out a way to make it work so you can still win in that deal. And that's a big thing, you guys. It's not like that everywhere. So I really like that Rain City has that component in there. The other thing is our company is, we've been in the business for, gosh, what do you say, 11 years? 12, 15 years? Thank you.
Yes.
So 15 years. I've only been in the company a couple of years, so I was sorry, at least on that
Teamwork.
one. But so industry pros, like people have reviewed deals, have done flips themselves. We have a ton of experience in this business. So we will help you guys every step of the way, advocating for you. Lesa and myself, part of our job is really to vet the deals with you and figure out, is this a good deal or is this a bad deal? Is this something you should proceed on or let it go? Can we tweak it a little bit to make it a little bit better? So that's kind of a service you get with Rain City Capital. It's a really cool factor. And like I said, again, we're in it for the long haul, long-term relationship. We don't want just do one deal and then move on to the next lender. We're working for long-term business. If we help you do well, you make lots of money, come back to us for another deal. And Lesa and I both have clients that have done many deals with us for many years. And it's a great partnership because you build credibility with us as a borrower, and then you get more and more clout, and deals get approved easier. You have that flexibility. We're working together, and it's just easier to work with somebody that you build a relationship with than always be going to this and figuring out their process, and then you have no relationship, so they're like, whatever, this is the contract, bye. So that's why I think Rain City, why people would choose us. So
100%. And I'd love to add too that we're all local and here.
Yeah.
When you go to a big company, you're going to have someone in California give you an ARV of an area that they've never stepped in, shopped at, or been around. So besides, I mean, Chris was 100% by all means accurate on why choose us, but the element of we're here, we have boots on the ground everywhere that we lend, and we know the area, and we're the human element of, let's say an ARV doesn't come out what you want. That communication factor is there, that you can give us a call versus someone in California is like, no, it's like a quarter of a mile radius says that this is the price and this is the price. Well, we know that one street might be really nice, and then the next street over might not be so much. So you have to go east or west of that subject property because we know the area. So I would just add that as well. It does benefit and it does help 100%.
Yep.
So cool. All right, let's go to the next one. So because we've talked about so many different programs, we want to end today just kind of like with a brief overview for you of just like snippets of what we have. So then that way, I'm sure you have some questions. You reach out to Chris and I, happy to help you. Is remember, bridge loans, that's fix and flips or buy and hold, fix and flips, buy and hold, renovation, not renovations, bread and butter. The more you do, the better the rate, 12 to 8%. Our 30-year, Chris did a great job of explaining our 30-year program. That's for when you're going to hold it. So you can use us for both the acquisition and exit strategy. We have cash collateral. We have land collateral. We have ways to be creative with your financing. You just tell us what your goal is and talk with us and we can figure it out. We have new construction. If you're wanting to do ground up, we can do land. We also can do manufactured home swap and or fix and flips. So all of those programs are at your fingertips when you find the deal. And really the lending part is the easy part once you find that deal. Chris, what about you? Do you want to add anything on that one?
No, I think you nailed it. I mean, I would say for us, it's neat. Like we interface with a lot of hard money lenders out there, guys. And there's, different 31 flavors of hard money lenders, right? They all have their, I like this, and I don't like that, I like this. I like that Rain City Capital has a little bit of everything, kind of the one-stop shop. Mm-hmm. There are very few things that I would farm out to somebody else and say, oh, that's not us, go out here. So it's neat that we're able to say yes just about all the time. So yeah.
Yes. Just don't bring us a gas station unless it's a really good deal.
No laundromats. Yeah.
And gas stations, but everything else. But if it's a good deal, let's talk. So
I know.
Always great. Go ahead, Chris.
Yeah, guys. So yes, we just want to say thank you so much for sticking with us to the class. So for us, I would say any questions you guys have on these programs or a deal you want us to look at, please just reach out to me or Lesa directly. Either text, email, phone, whatever, Facebook, social media. I think we've done it all. So yeah, reach out to us. Our contact info is right here. We also follow us on Instagram and social media. I was going to say Facebook too. We have our Facebook group, the Capitalized group. And that was mentioned in my pre-scripted stuff, but we do have our Facebook group, Capitalize, that you guys can buzz into as well. Other than that, happy holidays. Hope you guys enjoy the season and take a little breath. And we'll hit it again with a live class in January. Mm-hmm. Please, send any feedback our way. If you have topics or things you want to hear more about, that is how Lesa and I often develop our classes together, is off of your feedback. Hey, I want to hear more about this or that, or this, So yeah, please send in your ideas of what you guys want to see. And I think that's it. I guess see you guys in January, Lesa.
Yep. See you in January. I hope to see you guys live and see your guys' amazing faces and tell me what you guys ate for Christmas. So absolutely.
I love it.
Thank you guys.
Happy holidays, guys. Bye.
Bye.